Thank you for joining us today. As we're halfway through the second quarter, we continue to see an uptick in foreign accounts receivable insurance requests for U.S. exporters. LSQ, with the support from Exim Bank and OneSource, have partnered together to assist exporters in looking for ways to stay competitive, enter new markets, and/or expand with existing markets. My name is Renee Jackson. I'm the National Sales Director here at LSQ, headquartered out of Denver, Colorado. Also joining me today, we have Ariam Vasquez. Ariam is the Chief Economist at Export-Import Bank of the U.S. Prior to Exim, Ariam has had several roles in economic and investment strategy. Ariam's colleague, Ursula Vegzanovic, is a broker account manager for Exim Bank. Ursula is an experienced business development manager with a demonstrated history of working in the trade finance and logistics industry. Skilled in negotiation, trade finance, business planning, banking, and sales, Ursula is definitely a welcomed addition to today's webinar. John Steele serves as First Vice President for OneSource Risk Management and has over 30 years experience in the credit insurance business. John has worked for both Dun & Bradstreet and Euler Hermes and specializes in all industries with a heavy emphasis in foreign credit insurance. Prior to handing the floor over to Ariam, Ursula, and John, I'll just provide you with a brief high-level overview of who we are and what we do here at LSQ. LSQ is based out of Orlando, Florida, and was founded 25 years ago by a gentleman by the name of Max LSQ. Currently, we're one of the largest privately held working capital finance companies here in the US. We do have a national footprint and have funded over $25 billion to small to medium-sized businesses. And over the last, I would say, past 25 years, we've established pretty close to 500 partnerships in an effort to act as an incubation tool, primarily by bridging the gap to companies in a transition period and/or high growth mode. LSQ is also an approved lender under Exim Bank's foreign AR credit insurance policy. To highlight today's agenda, during the webinar, Ariam will provide us with an economic outlook from a global perspective, including macro activity aggregates, GDP trends, and forecasts. Ursula and John will review the current credit insurance landscape and the benefits of really leveraging insured receivables to overcome cash flow obstacles. At the end of the presentation, we'll welcome you to ask questions by using the webinar control panel. With that said, Ariam, I'll go ahead and hand the floor over to you. Thank you.
Thank you very much, Renee, for the introduction, and a very good afternoon to all. My name is Ariam Vasquez. I am the Chief Economist for Exim Bank. My team and I basically lead the bank's global economic forecast and outlook, as well as the country risk ratings that guide the repayment risks associated with U.S. government lending to foreign countries. I want to thank LSQ for the invitation to present today. I certainly welcome this opportunity to share some of our insights, some of our perspectives on how we are thinking and viewing the current global economic backdrop. We're almost halfway through the year, and despite considerable improvements and a much rosier global economic growth outlook, the climate remains fraught with risks, challenges, and concerns. So I have a few slides to get us through here, and I'll look forward to your questions and comments thereafter. So if we move to slide number 2, so the COVID-19 crisis remains front and center, and despite considerable improvement in recent months in containing the spread of the virus, we think it's fair to say that the COVID pandemic remains a principal concern to the state of the global risk and economic outlook. And I say concern and not risk because I sense that for the most part, the global community has a pretty decent handle on how the virus works and, more importantly, how to contain it. We've seen a very robust U.S.-led global vaccine campaign that began last year and has been continued, extended, and accelerated worldwide. And together with these targeted restrictions and lockdowns across a number of countries and regions, there has been a great deal of success in reducing the spread of the pandemic. And the data today does point to reduced infection levels, lower hospitalization rates, and importantly, lower mortality rates. Still, for all these advances in the COVID front, that's probably too early to say that we're out of the woods, especially at the global level. I think if you look at the data, the vaccine campaign remains largely uneven. While much of the developed world economies are having considerable success in this inoculation campaign and their economies are gradually returning to normal, the same cannot be said of conditions and trends in a number of emerging markets and frontier market economies. These are economies where the supply side constraints, cost limitations, and logistical pressures continue to limit the effectiveness and accessibility to the necessary vaccine. Such concerns are probably most prominent in Africa, even though the region has miraculously shown very low infection and mortality rates. It's also very prominent in Latin America, and that's a crisis that's a region that's been hit hard by the crisis. Although it must be said that the inoculation process has been ramped up in countries such as Brazil, Peru, and Chile, and we're starting to see some initial progress in terms of bending the curve. Importantly, many regions are also dealing with second and third wave risk. India is most at risk at this point, and the virus continues to spread. The death toll is rising fast in that area of the world, and the pandemic is in India certainly impacting the region. It's disrupting trade, it's slowing supply chains. Several other countries in Asia, such as Singapore, the Philippines, Indonesia, Korea, have also reinstated restrictions as they're dealing with new strands of infections. So again, COVID challenges are still with us, but I think for the most part, the risk of the pandemic worsening and resulting in renewed dislocations across the global trade, capital, and credit channels seems highly unlikely. We'll go to the next slide. So the focus of these next two slides are on the state of the global outlook. At this point, I think we find ourselves in this middle of this resurging confidence about improved sentiment over the state of the global economy. We've moved from a period of hurting and healing to one of start and recovery. The confluence of this global vaccine and this inoculation rollout and sustained policy support from the world's principal economies has led to considerable optimism on the global growth outlook. And more importantly, the last couple of months, we continue to see concrete evidence of improving economic trends across countries, across regions. The data is very clear and reflective of improved momentum. You're seeing it in the manufacturing and services PMI, which continues to push higher. Mobility indicators are more robust. Employment trends are better. Retail sales, auto sales, shipment figures, capital export orders, confidence and sentiment indices. These are all showing sequential monthly gains that speak to the surging economic momentum. We also put heavy emphasis on supply side metrics. So we track and follow a lot of these global electricity usage rates, railway, port traffic, cement and steel consumption patterns. And all these also speak to improved economic momentum at the global level. So if we go on to this next slide, this basically captures how all this improving GDP growth momentum is leading to rosier forecasts across the world economy. Now, much of it reflects base effects dynamics. But again, given the unprecedented levels of policy support, we are seeing signs of economic strength. The issue is that we're evidencing growing disparities and unevenness in the scope of these upside growth revisions. It's far from a synchronized global upturn at this point. The U.S. is clearly leading the charge and will likely outperform most of the world in terms of GDP. We're now looking at an annual GDP growth rate of around 7% this year here in the U.S. China, for all intents and purposes, is slowing down, but they're still clocking at around 9% GDP growth this year. And this contrasts very sharply with regions such as the Eurozone, countries such as Japan, where their growth is slated at around 4 to 3% respectively. The emerging market universe as a whole will probably grow around 7% GDP, but much, if not all of that growth, that 7% comes from the Asian basin. Eastern European and Central European economies are still lagging, and Latin America and Africa is still struggling and underperforming. The issue now is how sustainable is this rebound? That's a question we get a lot. Will it continue into 2022? Our modeling shows that this torrid pace of growth is just simply unsustainable. Much of the current growth surge is coming on backs of the expansion in the United States and China. And the rest of the world is really struggling to recuperate much of that lost output observed during the COVID crisis. As I mentioned in the call last time, the output gaps across a lot of these world economies are vastly negative. Very few economies, aside from the US and China, are operating at near or full capacity. Lastly, I sense once the policy stimulus begins to wear off, the global economy is likely to settle into a more moderate, sustained pace of economic activity, and we should start seeing such moderation as early as the third quarter and fourth quarter of this year. The next slide drills down a little bit with respect to the state of the global trade and supply chain outlook. It's an outlook which, despite some underlying challenges related to port delays, input shortages, elevated freight rates, if you will, It's an outlook that remains quite supported, especially because you have such improving growth dynamic at the global level. Still, there are some key developments that really further support the outlook for global trade and commerce and the overall supply chain outlook. And first and foremost is the Asian region. It's a region which really controls the global trade and supply chain uh, dynamic. It's a region with strong, robust macroeconomic health. Political stability is assured. These are countries with vast degrees of policy flexibility and maneuverability to navigate difficult global challenges. Asia was the region first in and first out of the COVID crisis. You saw China respond aggressively with targeted policy support for exporters, manufacturers, heavy industry producers, critical supply chain operators. And this is a trend that was replicated in countries such as Korea, Japan, Taiwan, Vietnam, Indonesia, you name it. Really, such efforts have allowed the region to recover rapidly while protecting the nation's export base and supply chain infrastructure. Importantly, this is a region that continues to advance uh, free trade structures. You saw it in the Regional Comprehensive Economic Partnership deal of last year. And again, you're looking at a region that accounts for 30% of the world's population, 30% of global GDP, and really the strength of the region is a huge benefit for this global trade and global supply chain outlook. The other factor is that the COVID crisis has really not resulted in the material destruction and reorganization of supply chains that many had expected. If you read a lot of the academic literature, everyone was expecting this massive restructuring of global supply chains, and that really hasn't materialized. There are, and we continue to see some changes in terms of source reorganization and digitization and automation, making supply chains more reliable. That's to be expected. And there are certainly regional challenges that speak to higher input costs, port delays, but we really haven't seen the systematic diversification and unprecedented destruction of inventory that many had expected. Moreover, this talk of supply chains decoupling, moving away from China and the Asian region, also has not transpired. Asia is too important and too beneficial in terms of business opportunities. And if there is a trend, it's further regional consolidation in terms of trade and supply chain development. And the last factor, I sense, is the fact that we're seeing fading trade war risks at this point. This wasn't the case maybe a year ago. This is not to say that geopolitical and trade tensions are to be ignored, but relations still somewhat delicate between the U.S. and China, and we can't discount that risk, but for the most part, the risk of a full-blown trade war is very low. It's simply too economic, costly, and politically challenging. And the fact that you still have important regional trade agreements coming forward, whether it's between the UK and the EU, whether it's the RCEP or the Continental Free Trade Area in Africa, the USMCA, these are all proof and solid examples that free trade is trumping, if you will, trade war risks. The next slide, and I want to end here, is just basically giving you some perspective on some of the risks and challenges and concerns that we're constantly monitoring and that we feel can alter the global backdrop, the global economic outlook. First and foremost, inflation. Inflation is now a serious threat, probably more of a near-term concern than a worrisome long-term risk. The street is divided on whether we're looking at a transitory phase or a prolonged inflationary spiral. We are not going to argue for an impending structural inflationary crisis, but inflation will be more prolonged than previously expected and will remain with us well into 2022. Our rationale here is based on several key dynamics. For one, you have surging demand and pent-up savings, and this is driving prices higher. You have labor shortages, which are becoming more prominent, and that will fuel increased wage and price pressure. Importantly, we're seeing growing signs of overheating in global manufacturing and industry. Factories are struggling to keep up with surging demands for goods. Supply chain constraints are evident, and this is triggering production input shortages, elevated freight rates, long delivery times, and a sharp increase, moreover, in global commodity prices. A more worrisome inflation risk, moreover, stems from the view that much of the global fiscal and monetary policy settings are unlikely to be altered anytime soon. And the threat that higher benefits and direct transfers turn into permanent fixtures of fiscal policy, that will certainly fuel more prolonged inflationary trends going forward. A second challenge or threat that we see is fiscal fiscal conditions and poor debt dynamics. This is an equally pressing challenge and a most worrisome long-term risk in our view. You're seeing massive debt buildups and widening budget deficits for as far as the eye can see, especially within developed bloc economies. Um, Governments seem only focused on continued spending, higher taxes for households and corporations, increased regulations, and if sustained, as we very much fear, this trend will further enhance the growing role of governments, not only in economic policy, but in business affairs, while undermining sovereign and non-sovereign conditions. The risk here is that further erosion in a nation's fiscal balance and rising debt load speaks to a policy dynamic that not only will limit a nation's capacity and resources to respond to shocks and adverse developments, but this deficit financing and debt dependency, it's really detrimental because it crowds out private sector. It undermines productive investments, namely via higher taxes. It adversely impacts and manipulates capital structures, interest rates, negatively impacts net exports. It will certainly lead to more unproductive growth, fuels higher inflation, all that good stuff, if you will. So something that we keep an eye out for is the poor debt dynamics and deteriorating fiscal conditions that we're seeing worldwide, really, not just across the developed bloc economies. A third point here, a risk concern is as it relates to the dollar, global commodity prices, bond yields. We look at three main prices: the price of oil, the price of the 10-year government bond yield, and the U.S. dollar. And all three have displayed fairly interesting developments as of late. So demand and supply dynamics are speaking to sustained price pressure on commodities, especially on oil prices. You have this global decarbonization measures and growing international regulations against the energy sector. And these underlying supply side constraints speak to continued rises in energy prices. While on top of that, you have these ongoing import shortages, elevated freight rates, and so forth. That's leading to higher commodity prices. And in recent weeks, you've seen a surge in metals, lumber, ag prices. Global bond yields also keep your eyes out peeled for this. You're seeing a steady increase in global bond yields. This merits attention. It's especially critical for the global trade outlook, given its impact on global liquidity conditions. And this speaks to the outlook for emerging markets. Liquidity is critical to these developing bloc economies that drive much of the action on the global trade front. And if we were to get sustained higher yields, a tightening of liquidity conditions would have tremendously adverse impact, especially on the more vulnerable emerging and frontier markets that are so capital dependent. If we get another run up in yields, capital and credit could stop at the drop of a dime here, and that would be critical. It would critically undermine the growth and trade outlook. And lastly, we have the ongoing trends in the dollar. Despite the clear growth and interest rate differentials, the dollar is against the ropes. You've seen in the Bloomberg index, which is down 3% since last month. The DXY is also markedly lower. The reality is that the Fed is not budging. The jobs report has disappointed. You have underlying twin deficits, growing concern here in the U.S., and you have somewhat of an anti-market rhetoric coming out of Washington. And this is spooking investors' worries over their faith and confidence in the U.S. dollar. A weak dollar may be good for exports, but in reality, it masks underlying imbalances and structural dislocations in a nation's economy. Importantly, it can fuel inflationary pressures, it destroys purchasing powers, it aids low productivity sectors, and it aids the government at the end of the day. So a weak dollar is something that we worry about. It could be of game changer nature. I think a number of emerging markets obviously benefit from this weaker dollar as it leads to more restrictive financial conditions and allows for wealth and capital to migrate back into developing bloc economies. But it's something that we need to take a little bit more seriously because we're seeing these trends begin to take hold here. And lastly, the last risk concern that I'll mention here is geopolitics. It's a very unruly political backdrop. Anywhere you look, there's tension, there's crisis, there are issues. We have renewed tensions between the Israelis and the Palestinians, Iran, Turkey flexing their muscles, Russia and China growing increasingly closer as they continue to widen their sphere of influence in a number of regions. In Latin America, you're seeing the region, again, the pendulum turn back towards populism and radical economic heterodoxy. Africa, still fraught with uprisings, civil unrest, terrorism, humanitarian crisis, you name it. And let us not forget that the state of superpower relations between the U.S. and China remains very, very delicate and far from improving. So all in all, it's a very worrisome geopolitical climate. Expect continued volatility and uncertainty, and I think that's going to weigh on the overall outlook. So with that, I will stop here. I certainly look forward to your questions and comments, and I will now turn the call over to John Steele on the credit insurance landscape.
Thank you, sir. Appreciate it. That was excellent. My name is John Steele. I'm with OneSource Risk Management, and we are the largest credit insurance broker in North America. We have a national footprint, and we're pretty proud of being a gold standard XM broker. XM evaluates their brokers based on volume, and we've been doing quite a lot of business with them. Our headquarters is Portland, Maine, with a service center in Houston. We have over 1,000 clients. Basically, what I do is, with one application, I can go to the entire credit insurance market to find the best price, coverage, and structure for my clients. And often, it is XM Bank. Next slide. So I want to talk about the current landscape of credit insurance. As you can imagine, the last 12 months plus have been pretty ugly. It was the most and hardest I've ever worked in my life, yet the most challenging at getting client coverage and keeping policies in place. We lost several clients because of the pandemic, and credit insurance, they're starting to get back now, but the problem we're having is capacity. A lot of the foreign countries still remain in lockdown, so it's very difficult in some cases to get insurance. The cost is increasing, the cost of reinsurance is increasing, so it's basically what we consider a hard market. All right, there's soft markets and hard markets. This is a very hard market. Minimum premiums are also rising, and that's not good for the small exporter. And that's what XM is about, is trying to enhance exports going out of the U.S. and helping the small exporter. So I guess we're going to pass it over to Ursula to talk about. Yeah.
Thank you so much, John, and thank you everyone for joining us this afternoon. Special thanks to Renee and the whole LSQ team for having XM here today. So if we can move on to the next slide, I'll just do a quick introduction for those of you who might not be very familiar. Export-Import Bank, or XM for short. We're a government agency, and basically we provide different financial and insurance tools to assist companies who are located in the United States be competitive when they're selling abroad. Where on the screen it says that we're the official export credit agency of the United States, and that just means that, again, we offer these tools to support our U.S. companies, much like our competitors. And so there are export credit agencies in about 80 countries around the world, and they do the exact same thing for their local companies. They're trying to help their local companies export more. So at the end of the day, we're an economic development agency, and with us, the focus is specifically on trade and on exports, even more specifically. We have offices all around the United States, and in normal times, that is a benefit, because when we're back, hopefully to be back in person soon, we try to meet with companies in their local marketplace. Go to the next slide, please. So going to talk a little bit about who it is that we support. And John alluded to that we work with small business exporters, and about 90% of our transactions are direct with small businesses, but we really can work with any size company. We're probably best working in the small business space and then in very large transactions. Some of you might know us as being a supporter of Boeing and other large companies. So kind of from one extreme to the other, the middle ground is probably where we play the least, and where a company like OneSource is an important partner to kind of figure out for your particular needs where is going to be the best fit in the marketplace. Because XM Bank is essentially the public sector insurance carrier, and when it comes to trade credit insurance. And again, we're looking at working with U.S. companies regardless of ownership. So even if it's a foreign-owned company with production here in the United States, and it's not just tangible goods exports, but we also provide coverage for service companies. We can go to the next slide. So what exactly is credit insurance for those of you who might not be as familiar? It is really just an insurance policy for your accounts receivable. Here at Exim Bank, we're focused just on the foreign accounts receivables. As I mentioned, John and OneSource work with companies in different insurance carriers that can provide insurance cover both on domestic as well as on foreign. And the reason why companies look for credit insurance is kind of threefold. In some cases, it is the need to offer more competitive terms, and also wanting to sleep at night and knowing that you're going to get paid at the end of the day. So those are two definitely big drivers for a lot of our clients. And for many, it is also financing. A lot of the companies that we work with already have a number of foreign either distributors or end users that they're dealing with day in and day out. And those foreign receivables are not eligible collateral with their banking institution unless there's credit insurance wrapped around that foreign receivable. So that now unlocks additional collateral for most companies. And there's a number of different ways that we can structure policies. If we can move to the next slide, we'll start off with the discussion on single buyer in just a moment. Really quick though, what exactly are the risks? So a sale, we say a sale is not a sale until you get paid. And so what keeps most of our clients up at night is exactly that, the ability to collect payment. And there are a myriad of reasons and risks associated with that non-payment. Some of it could be a foreign government's actions that would prevent the foreign customer from making payment, whether the currency is inconvertible or if there's any kind of as Ariel just discussed, geopolitical risks that, erupt in terms of war and insurrection. But a majority of the times that we see claims filed, it is for commercial reasons. So whether that's bankruptcy or insolvency or simply slow pay, you may be selling to a distributor dealer who is on selling that product to an end user. If that end user doesn't pay that distributor, oftentimes you as the supplier here in the United States is going to feel that effect. There's a domino effect. If your customer is not paid, they may not be paying you. And that is reason enough to file a claim on an insurance policy. We can move to the next slide. So as far as credit insurance is concerned, there's a few different ways to set up policies. Some companies come to us and say, we already do business internationally. We're comfortable from a credit risk standpoint, but we're entering a new market. And this is a market that we don't feel as comfortable with. We don't have access maybe to the information that we'd like. And so they can come to us on one-off transactions. And the other thing that we've seen, and John will talk about this a little bit, is that some of the private sector carriers have been unable to maybe renew credits or give as high of credits. Some companies have maintained their private sector insurance policies and then just come to us on a one-off basis for a particular client to get insurance coverage on that. So the single buyer policy is a 90% cover. It's always issued for a year period of time. There's no deductibles. What's great about the single buyer policies, our rates are available online. So for companies who are in quoting stages, they can often look up what the cost of insurance is, and typically it's going to be less than 1%, although it does depend on the term, but just to give you a sense of what the cost might be. So for example, in Mexico, if you're selling on 60-day open account terms, it would be less than 1%, about 84 basis points to insure 90% of your receivables. So you have a $100,000 sale, you're going to have insurance cover on 90,000 of that. In case of non-payment situation. The other advantage that we offer in terms of these types of policies is that although we do ask for projections in terms of what the anticipated sales are for the next period of time, really the premium is paid based upon actual sales that occurred. So if a sale occurs in the month of May, is invoiced in May, insurance premium is not due to us until the following month. So that's definitely an advantage that we offer. We can go to the next slide. And I'm actually going to have John jump back in here to talk about a client that is a company that we worked with jointly. It's a client of LSQ and OneSource that came to Exim Bank for single buyer coverage, or for insurance coverage, I should say.
Yeah, thank you, Ursula. Appreciate it. Yeah, OneSource, we're really proud of our partnership with XM. And this is a great classic story about how this partnership helped a digital identity software company selling software licenses, right, to multinationals. They had a true concentration, 95%. I mean, if you have 95% of your receivables responsible for um, without any other customers, you should have insurance on it. If you have that kind of concentration, that is a huge loss, right? You're basically out of business. You might be out of business anyway because your biggest customer left you. However, you could be out of business with 90% of your money in your pocket. So concentrations are an issue. This private companies, the private market had zero capacities for this guy. So we couldn't get coverage with the other carriers. And he had an operation in Western Europe he was selling to, needed $1.5 million, and also South America. Now you look at this and say, how does this fit XM? There's no product, there's no like manufactured product, because this is software. So we actually have a service endorsement because they were actually providing a service, software service, which got us over the hump and got this policy written. So what we did on this story here is prove that it was US product, prove to XM the debtor was solid by getting 3 years of financial statements from the account debtor. And once the policy was in place, everybody wins. The customer ships on open terms. This guy's not going to pay cash in advance, 1.5 million, right? So the open terms was handled. The bank then became the lost payee of the policy, so the bank was happy. And of course, the happiest guy over there is probably the president and salesman, who now expanded their sales safely to a foreign market. So that was basically the takeaway here on this story. So I'm going to pass it over back to Ursula.
Yes, thank you so much, John. Yeah. So the other option that we have for companies is multi-buyer insurance policy. So just like it sounds like, you have one insurance policy with a number of buyers under one policy. And we have some companies who come to us and say, we don't want any foreign risk, so we really want you to write us a policy to cover all. And for many companies whose prime motivation is financing, this is probably a way that they're going to go. And within this realm of multi-buyer, there's just a few different options. We have a standard policy that's really available to any size company. And here, when we price the premium, this isn't something that you can pull off our website, but instead, we take a look at what countries are you selling to, what are the payment terms, is it net 60, is it net 90, is it something longer than that, kind of what's the mix? And then we come up with a one premium rate. So the advantage of that is that we do have clients who have several separate single buyer policies, and then their premium rates are going to vary market by market, where here they have one premium rate for an entire year across the board. And again, the advantage is knowing what that cost is, so that it can be built into the product cost or added onto the invoice, and ultimately, hopefully, the foreign customer is really the one paying for it. We have a variety of policies that are targeted specifically to the small business community, which basically means that there's a little more risk that we're covering. So there's typically no deductibles with those types of policies. And for us, a small business, if you're a manufacturer, it's typically 500 employees or less. It's actually whatever the Small Business Administration's definition is of small. Plus, from XM's perspective, we would look at companies that have less than $10 million in export sales on credit specifically. So maybe you have $10 million in exports, but half of that is on a prepaid basis or letter of credit, and the other half is on open account. We would consider that to be a small business. So this express policy that's up on the screen is really for companies that are just not small businesses, but also new to the export landscape. So one of the features of this policy is that we're doing a little bit more due diligence on behalf of the exporter on who that foreign buyer is, understanding that typically they're smaller shops and they might not have as much of a credit department. And so we're offering that additional service. We can move to the next slide. One thing we're proud of is that we've made public our credit standards. So we're very transparent in terms of what information we're going to want to see and review on your foreign customer. And this is super helpful because it gives you the ability to be proactive and ask your customers upfront, whether that is through a credit application or just verbally, letting them know that if we're talking $100,000 of credit, what we would want to see is either your company's experience in giving credit to this buyer overseas, or can ABC company, Indiana, provide a reference on doing business with XYZ company in Mexico, for example. So really just a reference, our ledger experience, absent any of that, no one's given them credit overseas before, then, we'll pull a credit report, or we will ask for a credit report to be provided. It's not until we reach $500,000 of outstanding credit at any given point in time that we ask for financial statements on the buyer. Sometimes we run into exporters who are shy about asking for financial statements. That's sort of another benefit of working with a broker. Like one source is that they potentially can assist you, in wording how to ask for that information. I mean, our philosophy is that at the end of the day, if you do not want to ask for it directly, if you're going to ask your broker to do that, or you want those financials to be sent directly to Ex-Im Bank, that's your call. But you don't have 100% coverage from Ex-Im, you do have skin in the game, and we feel like you have the right to know the financial standing, of the customer that you are extending credit to, because you do have some skin in the game in this transaction. But some companies use our credit standards to write their own credit policy. They've definitely done that, and we're happy to share that. We can move on to the next slide. So kind of what is the process? Really, step one is to talk with us so that we can understand what your particular need is, and we can tailor a solution to what it is that you need. You know what information we're going to want on your customer, so it's a good idea to have an international credit application, although it's not required, but it's just a way for you to be organized and collect the information from your customer and then be able to provide it to us or to any underwriter for that matter. You'll submit some information on your company as well as on your customer, and usually in 2 to 4 weeks time, you're going to have an insurance policy in place. And then once you actually start exporting, start shipping your product, or start invoicing for those services, it's after that you'll actually pay premium. And of course, we want you to keep copies of documents like your purchase order, your final invoice, your bill of lading, if it is a product that is actually being shipped, because those are the items that we're going to ask for in the event of a non-payment situation. We can move on to the next slide. So just a little bit more about who it is that we are looking to work with. So ideally, we're looking for companies who have been in business for at least 3 years. Doesn't necessarily mean you've been exporting for that period of time. A little bit of experience is always helpful, but we're open to working with new exporters as well. Again, there's no really size limitation in terms of what size company that we could work with. On no floor, no ceiling really. And we're looking for, again, providing support to U.S. companies, because at the end of the day, we're interested in supporting U.S. jobs. And so we're looking for the product to be manufactured or supplied from the United States, 50% U.S. content. So exclusive of your markup, but everything else can be counted in towards that 50% or 51%. And the final shipment should also be from the United States as well. So we sometimes run into companies who have majority, 70% made in the United States, but maybe final assembly is in Mexico, and then it goes on to the customer from there. That particular scenario doesn't work for us, even though it's over 50% US content. We really need that final shipment to take place from the United States as well. We can move on to the next slide. Just a little bit more information on us. There's about 180 markets around the world that we are open to do business in. That does change periodically. We have on our website what we call a country limitation schedule. And it kind of sets out all the countries in the world and gives you an idea whether or not we're open for business in a particular market. And we divide that into kind of 2 sections, whether you're selling to a foreign government, or if you're selling to privately owned entities overseas. And sometimes, in some countries we might be open in one area but not in the other. So it's definitely important to consult that, and that does change, as things change in the marketplace. There are no costs really from an underwriting standpoint. Of course, when we ask for credit reports, there's a cost associated with that, but we don't charge any underwriting fees or application fees. And then we highly recommend working with brokers like one source. They are knowledgeable and can speak to our underwriters in a language that our underwriters understand. And also because they understand the entire landscape of the credit insurance market, we have customers who have used Ex-Im and who we say graduate out of Ex-Im because now maybe the sales have increased and the private market is more competitive from the pricing standpoint. We're not here to compete with the private market, but rather fill in the gaps when they exist. And then I'm going to turn it over, if we can go to the next slide, back to John again, who's going to talk about one more case study.
Thank you, Ursula. Appreciate it. I want to speak now to the benefits of working with a broker. Obviously, with XM Bank, you need to work with a broker. And when you choose a broker, choose one that has experience. And this is all I do, nothing else. All I do is AR insurance. So what I would do with an applicant is firstly, ensure they're a good fit for XM. Look at on the green slide here, exporters must. So look at those items, ensure a good fit, and vet out the risk, okay? The 3-year thing we sometimes get around with an experienced exporter that changed companies or has been in business for a while and moved over to a new company. So sometimes that goes away. DUNS number is important. US content always important, and restricted countries are critical. Plus the military. You know, I always say if your customer has the president of the country you're selling to wears a military uniform when they're making their address to their country, it's not a place you want to sell. So that's what we typically, the rule of thumb there. So we basically streamline the application on onboarding, right? Through communication with XM, with the client. We help you with the portal. And Ursula pointed out something before about gathering financials. At OneSource, we have a CIS department, a team of people. That's all they do all day is gather financials for our customers. And we can set NDAs up to NDA directly with the XM underwriter where nobody sees the financials but XM. So there's a way to do that as well. All right, so that's something important when looking at financials because that's kind of a taboo subject. How do you get somebody's financials, right? Call some guy in France and say, hey, send me your financials. You might not receive them. So other things we do with the benefits is crystallize the coverage, right? We want to make sure the coverage is in place, do reminders, just manage the policy, help you through the minutia. It's very easy. It's an online portal. XM has one of the best online platforms in the business. It's very simple to use. The pricing is right there. I mean, there's no surprises, okay? But our job is to make sure monthly reminders, you're doing your sales reporting, paying your premiums, and of course, filing a claim on time. I mean, if you're going to buy an insurance policy, you should probably file the claim on time. So that's critical. Next page, please. So I want to talk about a quick case study, and then we'll go to the some questions at the end for everyone. So I had a company, I had a private insurance policy with the top private market, Euler Hermes, and there was a buyer decline in Japan. This guy was very active. He has about 10 million in sales, 20% international and growing. His international sales were really taken off. He was in the nutrition business for pets, basically organic pet food. So Euler Hermes would not approve this company in Japan. It was in the middle of a pandemic. Things were really ugly for all the credit insurance carriers. A couple have been downgraded already. I mean, it was doom and gloom back in July. I mean, people were hiding in their homes. It was really rough. So we said, let's go to XM and see if they would take a look at this Japanese buyer. We got some information, a credit report for them. We'd help them pull their credit report. We helped them upload it, put it into the portal, send the ledger experience they have, and basically got the 450,000 credit limit approved. And now my exporter is selling monthly up to 450,000, paying a 0.56 rate on that, and pays premiums whenever he ships. So if he ships 100,000, he only pays on the 100. So it's been really good for him. The bank was named beneficiary of the policy, which helped his funding. Right, he was with a regular lender. So everyone was happy. The sales team, the bank, the debtor, everyone's satisfied. And even in the photo, you can see a happy pooch driving down the highway in Japan, looking at the sunset with a belly full of organic food. Even the dog was happy. So anyway, I'll leave you with that. And so I'm going to pass it over to Renee to finish up.
Perfect. Thank you, John. I have to love the dog. Thank you, Ariam, and thank you, Ursula, as well. Remember to just feel free to submit your questions via the control panel. I know we already have a few in the queue. Let me start with the first one. So I think this is for you, Ursula. The question is, where do I go to apply for XM insurance? I have no intention of insuring our current accounts receivable, only future. Please advise.
Sure. So I would highly recommend going to our website, and we can send a link afterwards, Renee. I'm sure we can do that to those that are logged in to start with a consultation request with us, and we can kind of talk through and make sure that that's something that we can do, and then we'd probably make that introduction to the broker, like OneSource, to take you through the next steps of actually applying and so forth.
Excellent, thank you. Yes, and we will send, just for everyone, a recording of the webinar and everyone's contact information as well. Let me open up the next question here. This is for you, Ariam. What is the single largest risk to the current global recovery?
The largest risk, I think near term, probably further spikes in inflation as we expect a prolonged inflationary backdrop. I think that's certainly a concern to us in the near term. And I say long term, looking further out beyond the 1 year horizon, it's these poor debt dynamics, the debt buildup, the widening budget deficits that I mentioned, just because of their impact on their ability for governments to navigate, on the erosion of countries' ability to put its resources to good use, and the threats that this type of policy has on the private sector. So I think near-term inflation, long-term risk, poor fiscal dynamics, and higher debt load.
Thank you, Ariam. The next question, we have quite a few here. Is there a protection against advances paid to the suppliers?
I can answer that.
Thanks, John.
Yeah, I'm not aware of XM Bank having the advance payment endorsement, unless Ursula can chime in when I'm through. But in the private market, they do have such endorsement. So there is that type of cover. And Ursula, would you like to continue with your side?
Yeah, I was going to say we wouldn't provide an advance payment coverage, because again, we're looking at providing coverage on the exportation of actual product or a service. And so oftentimes we get questions about whether or not, like, there are milestone payments that an exporter is invoicing for. That's something that we just aren't set up to do, because again, we're looking at actually exporting either product or providing a service. The only other thing I was going to say is that what we hear oftentimes is that the buyer overseas who's providing advance payment will oftentimes ask for a guarantee or a standby letter of credit, which is a whole nother discussion on potentially what that impact is from a working capital standpoint for the exporter. But certainly a standby letter of credit is another.
Thank you. Let's see, next question. How does a non-bank ledger get delegated authority with the EXIM Bank?
I guess I'll take that one. So I have a team that's working with our lending community. There's quite a due diligence process that we go through, not least of which is examining that bank years of audited financial statements, and some other due diligence on the essentially the senior management within that institution. I'd be happy to send out more information to the inquiring party, because that's a pretty long answer.
Agreed. Yes, thank you. Let's see. Ariam, next one.
Yes.
Is the current economic expansion in the U.S. sustainable?
Good question. Remains to be seen, really. No, not at this rate. It's impossible for the U.S. economy to maintain these very lofty rates of economic growth. They're purely driven by unprecedented levels of policy support, and it's this type of policy support that can get us in trouble if it continues. We just can't keep priming the fiscal pump or the monetary pump forever. It will overwhelm us eventually. So no, I do not think the current growth trajectory is sustainable. We will eventually have to settle to a lower level, a more sustainable level of economic growth, and one that is less risk averse, in my view.
Thank you, Ariam. Let's see. I think this would be for you, Ursula. How does EXIM make up for export, to countries' currency that is lower than the US dollar?
So we don't make up for differences in currencies. That's a whole separate set of financial tools that really you have to go to your commercial bank or a company specializing in FX services. What we do though is if whether a company invoices in US dollars or whether they are invoicing in another hard currency, most of our policies are already endorsed such that euro and other major currencies that a US company might be invoicing in are covered. But again, we are not taking the foreign exchange risk. That is something that the company needs to separately secure themselves through a hedging contract through another financial institution.
Great, thank you. One more question. I believe this is for you, Ariam. Which emerging market region is most at risk and less at risk in the current global backdrop?
So most at risk, I'm not going to count Africa because Africa is more of a frontier and not an emerging market. It's still leagues behind a lot of these prominent emerging markets. Their level of industrialization is not as advanced. So most at risk is without a doubt Latin America. Latin America faces a number of macroeconomic challenges. A number of countries have reduced degrees of policy flexibility and maneuverability to navigate in these difficult years that we've been seeing in the past couple of years. And politically, it's a region that continues to move aggressively to the left. And when I mean left, I mean these are populist, these are anti-market governments, governments that are prioritizing very heterodox economic policy. So a lot of time concerns me going forward. Best equipped is without a doubt Asia. Asia is just they do everything the right way. They really do. They plan for the long term, and they make sure they save for a rainy day, and their economies are well managed. Institutions are strong. Political stability is there, and again, it's probably the most mature of the emerging market regions.
Thank you. Give it one more moment here. That is all I have for questions. We'll give it a moment here in the queue. Okay. One last one. This is for you, John. You may have touched on this already, but can we use a local general insurance broker to handle my EXIM policy, or do we need to use an EXIM approved broker?
That's a good question. I'm going to answer that question and then pass it to Ursula to see her response as well. I co-broker with a lot of the property and casualty guys. They come to me and say, hey, I have a client that needs XM, can you help me? And so we share in the deal. So we have a lot of co-brokering relationships with the P&C guys because it's not their specialty, Most of the brokers that are the elite brokers, I guess, in credit insurance went to DC for the training, go to the webinars and just basically ingrained in XM. So Ursula, finish that off?
Yeah, thank you for letting me chime in on that. So the quick answer is no, we would not be having companies work with a local property and casualty broker. The brokerage has to be registered with Exim Bank. There's a bit of a due diligence process. And frankly, as a former broker myself, I would only work with the top brokers that Exim Bank has, like a OneSource, because this is a specialty within the credit insurance space. Much like I wouldn't buy marine insurance from my property and casualty guy, I wouldn't get credit insurance either from that local person. It's just not an area of expertise, and there's just too much at risk. I mean, the cost of credit insurance is fairly low, but the cost to not comply with the policy is extremely high.
Thank you.
Yes, thank you. So that is all we have for questions. As I mentioned previously, we will be sending out a recording of the webinar over the next, I would say probably within the next 24 to 48 hours. But most importantly, just want to thank everyone again for joining us. Fantastic. Thank you so much, Ursula, Ariam, and John. And to everyone out there, have a fantastic rest of your day. Thank you again.
Thank you.
Thank you.